Warren Buffett has just executed a move so enormous, so deliberate, that it has sent quiet shockwaves through the deepest levels of Wall Street. And if you're watching this right now, you need to understand something very clearly. This is not just about him protecting his own fortune. This is a signal, a warning, a message about what may be coming for the global economy as a whole. And the fact that mainstream financial media is barely discussing it should immediately raise red flags about how serious this really is. The Oracle of Omaha, the most successful long-term investor in modern history, the billionaire who built his legacy by staying calm when everyone else panicked and striking decisively when others were terrified, has just unloaded nearly $1 trillion worth of stock holdings. And when I say unloaded, I don't mean routine portfolio rebalancing or minor trimming around the edges. I mean a systematic, sustained exit from positions he held for decades, positions he once described as permanent, forever holdings. This kind of selling does not happen randomly. It doesn't happen because of a minor pullback or a temporary market scare. It happens when someone with access to deep analysis, institutional level data, and decades of experience concludes that remaining invested has become too dangerous. And this didn't happen overnight. Over the past 18 months, Berkshire Hathaway has quietly been executing a carefully planned exit strategy, right out in the open, while most investors completely missed what was unfolding. Berkshire has now been a net seller of stocks for 7 straight quarters. In the most recent quarter alone, the company sold more than $75 billion worth of equities, while buying almost nothing in return. When you total up all the selling since early 2023, the amount of stock Berkshire has dumped exceeds $981 billion. This is the largest selling campaign in the company's entire history, larger than anything Buffett did before the dot-com crash, larger than before the 2008 financial crisis, larger than during the COVID panic. That alone should stop you in your tracks. Because the question is no longer if something is wrong. The question is, what does Warren Buffett see that you don't know? What data is he acting on that isn't being screamed across CNBC banners or Bloomberg headlines? What is he seeing in economic trends, balance sheets, and risk models that makes holding stocks at these levels unacceptable? And the most disturbing part of all this isn't just how much he be net selling, it's what he am selling. These are not speculative tech names or risky startups. These are cornerstone American corporations, blue chip companies that represent the backbone of the U.S. economy. Businesses Buffett himself has praised for their competitive moats, leadership, and long-term durability. Apple, Berkshire's largest holding for years, a position Buffett once called one of the best investments of his life, has been slashed by more than 67%. Roughly 2/3 of that stake is gone. This is the same company Buffett once said he would likely never sell because of its ecosystem, customer loyalty, and balance sheet strength. Yet quarter after quarter, he's been quietly exiting. Bank of America, another multi-decade holding built on Buffett's belief in the American banking system, has been reduced by over $40 billion. And every time the stock rallies, Berkshire sells into that strength, unloading shares as if it can't get out fast enough. And remember, banks are supposed to benefit from higher interest rates. Bank of America has reported strong earnings, yet Buffett is selling aggressively. And that should be setting off alarm bells about what he expects for the financial sector. Chevron, the energy giant Buffett bought as an inflation hedge and a bet on global demand, has also been cut sharply. Billions of dollars in shares sold, even as oil prices remain elevated and energy companies generate record cash flows. Buffett has long argued that energy represents real, tangible value in an economy dominated by financial engineering. Yet even these positions are being liquidated with urgency. The pattern is unmistakable. Buffett isn't rotating from one sector into another. He's not selling overvalued stocks to buy undervalued ones. He's not repositioning. He's exiting, almost across the board, and stockpiling cash. Berkshire Hathaway is now sitting on more than $325 billion in cash and short-term treasuries, roughly 30% of the company's entire market capitalization. That is unprecedented. And this is not normal behavior for Warren Buffett. This is not how he's operated throughout a 70-year career. This is the posture of someone preparing for something far more severe than a routine correction. Now, before you jump to the conclusion that Buffett is simply getting cautious in his 90s or losing his legendary edge, you need to understand one key fact. Berkshire Hathaway is no longer run solely by Warren Buffett. The company has 2 co-investment managers, Todd Combs and Ted Weschler, who oversee billions in investments. Both of them are decades younger and both are selling aggressively as well. This means that this is not the fear of an aging investor. This is a consensus decision across the Berkshire investment team. The market is overvalued, risks are elevated, and holding cash is now the safest strategy. The narrative the financial media would have you believe is that Buffett is simply taking profits after a strong bull market or waiting for better opportunities. But when you examine the scale, speed, and selectivity of this selling, it becomes clear something much more serious is driving this. Something beyond normal cycles, beyond valuations, and beyond the usual risk management playbook. Let's examine the underlying reasons. The United States now carries a national debt exceeding $36 trillion. The interest on this debt alone consumes more than $1 trillion per year, more than the entire defense budget, more than Medicare, and larger than any discretionary spending category except Social Security. And it's only getting worse. The Congressional Budget Office projects that, under optimistic assumptions, debt could reach $50 trillion within a decade. That projection assumes steady growth, moderate inflation, low unemployment, and no major financial shocks. An extremely optimistic scenario that ignores the natural cyclical rhythm of economies and the fact that recessions occur roughly every 8 to 10 years. We are well past that average window, making the economy statistically overdue for a contraction. When debt reaches these astronomical levels, the government has only a few options, none of them good for stock investors. 1. Grow its way out of debt. The government could attempt to boost growth rates above the interest on its debt, but global growth is slowing, productivity gains are insufficient, and this option increasingly looks like wishful thinking. 2. Raise taxes drastically. To generate enough revenue, taxes would have to spike, crushing consumer spending and slowing the economy, a move that could actually worsen the debt-to-GDP ratio. 3. Cut spending sharply. Mandatory programs like Social Security and Medicare have political shields. Deep spending cuts are almost impossible without triggering severe recessionary effects. And the fourth option, the one Buffett almost certainly views as most likely, is monetary intervention. That means the Federal Reserve printing money to buy government debt when private investors no longer can or will fund it, essentially monetizing the deficit. We've seen this before, notably during the COVID pandemic when the Fed AS balance sheet exploded from $4 trillion to $9 trillion in months. And historically, this is the predictable response whenever unsustainable debt collides with political constraints. The consequence? Inflation. Not short-term, transitory inflation, but structural, persistent inflation that erodes purchasing power over years and decades. Cash, savings accounts, and bonds lose real value, even if nominal balances appear stable. Middle-class Americans see their standard of living decline despite working harder and saving more. Social and political instability follows. This is the environment Buffett is preparing for. A future where cash is king, not because it earns high returns, but because it preserves flexibility, the ability to deploy capital when markets inevitably collapse and distressed assets are available at fire sale prices. Buffett has done this before. In 2008 and 2009, he used his cash reserves to buy into Goldman Sachs, Bank of America, and other high-quality companies at valuations that seem extraordinary in hindsight. Those moves generated returns far beyond what could have been achieved by staying fully invested during the crisis. The current cash buildup, that $325 billion war chest, is not for a minor pullback. It is being held for a once-in-a-decade opportunity. When the market corrects sharply, leveraged investors are forced to sell, and quality assets are available at discounted prices. And if you know what to look for, the warning signs of this impending crisis are already visible. The warning signs are becoming impossible to ignore. Corporate profit margins are at historically high levels, which may seem like a sign of strength. But history tells a different story. When margins reach these peaks, they almost always revert back down as competition increases, input costs rise, and pricing power diminishes. Every time this has happened in the past, stocks have fallen sharply as earnings disappoint and valuations compress simultaneously. Meanwhile, the stock market OS valuation relative to GDP, which Buffett has called the single best indicator of market valuation, is near all-time highs. It even exceeds the levels seen during the dot-com bubble. This suggests that stock prices are being driven more by liquidity and speculation than by actual business fundamentals. Consumer debt is also at alarming levels. Credit cards, auto loans, and student debt have all reached record highs, while savings rates have dropped to lows not seen since before the 2008 financial crisis. American households are stretched thin, and any disruption, a sudden interest rate spike, job loss, or unexpected expense, could trigger a wave of defaults and curtailed spending. The commercial real estate sector is quietly facing a crisis of its own. Office buildings in major cities have vacancy rates of 30-40% as remote work becomes permanent for millions of employees. These properties are financed with debt that must soon be refinanced at much higher interest rates than the zero-rate environment of the past decade. This creates the potential for a massive wave of defaults and foreclosures, which would ripple through the banking system, trigger liquidity shortages, and force government intervention. Regional banks are particularly vulnerable. Many hold commercial real estate debt and bonds that are now showing significant unrealized losses. These losses don't appear on quarterly earnings reports, but represent real economic capital that has been eroded by rising rates. And if depositors lose confidence and begin withdrawing funds, we could see failures similar to Silicon Valley Bank or First Republic, only on a much larger scale, potentially overwhelming the FDIC and requiring explicit taxpayer-funded bailouts. Geopolitical risks are escalating at the same time. Tensions between the United States and China are at Cold War level intensity. Conflicts in the Middle East threaten energy supplies and shipping routes. Russia continues its aggression in Ukraine, using commodity exports as leverage. International cooperation on trade, climate policy, and finance is breaking down. All of this creates uncertainty for businesses, forcing higher risk premiums on assets that depend on global stability. And then there's the US dollar. Its status as the world's reserve currency has allowed America to run massive trade deficits and accumulate enormous debt without immediate consequences. But this dominance is eroding. Countries like China, Russia, and nations in the Middle East and Latin America are developing alternative payment systems and trading arrangements that bypass the dollar. While the dollar's role won't disappear overnight, its declining monopoly will eventually expose Americans to the true costs of massive debt and consumption patterns. Buffett is seeing all of this. The high valuations, elevated margins, unsustainable debt, stretched consumers, fragile banks, troubled commercial real estate, geopolitical tensions, and the weakening dollar all point in one direction. A severe market disruption is likely coming. And Berkshire Hathaway's current strategy, systematically selling blue-chip holdings, cutting stakes in Apple, Bank of America, Chevron, and hoarding record amounts of cash, is his way of preparing for it. Not through panic, but through calculated positioning, preserving capital, and ensuring the ability to act decisively when opportunity and crisis collide. This is what sets Warren Buffett apart from almost every other investor alive today. He doesn't just react to headlines. He analyzes the underlying forces shaping the economy, the fundamentals, the debt dynamics, the geopolitical pressures, the structural imbalances, and positions himself accordingly. And right now, his positioning is unmistakable. He's moving to cash and preparing for a major market event. The pattern of selling is not random. It's systematic, across sectors, across decades-long holdings, and executed with precision. Apple, Bank of America, Chevron, all are being reduced dramatically, even though they remain strong, profitable companies. This tells us one thing. Buffett isn't reacting to company-specific weakness. He's reacting to systemic risk, the kind of risk that can collapse entire markets regardless of individual corporate strength. His cash pile, over $325 billion, is a strategic weapon. Not for modest corrections, not for minor market pullbacks, but for once-in-a-decade opportunities, when high-quality assets are sold at distressed prices because leveraged investors are forced to liquidate positions to meet margin calls, redemption requests, or debt obligations. Think back to 2008 and 2009. Buffett deployed capital when panic was at its peak, buying into companies like Goldman Sachs and Bank of America at valuations that now seem incredible. The returns he earned during that period far exceeded what could have been achieved by staying fully invested. The same opportunity is what he is preparing for today, a market event that most investors don't even realize is approaching. The warning signs are everywhere if you look closely. Corporate profit margins at extreme highs, stock valuations at historic peaks relative to GDP, consumer debt and low savings, leaving households vulnerable. Commercial real estate facing high vacancy rates and refinancing stress, regional banks exposed to hidden losses and liquidity crises, escalating geopolitical tensions, threatening trade and energy security, erosion of the dollar's dominance reducing America's financial flexibility. Berkshire Hathaway's move is more than a hedge. It's a statement. The safest asset right now is not equities, it's liquidity. Cash is the tool that preserves optionality, allowing Buffett to act when markets inevitably correct and to buy exceptional assets at prices that most investors will only dream of. For investors watching today, the lesson is clear. Pay attention. Watch the fundamentals. Understand the macroeconomic and geopolitical pressures that are creating systemic risk, and recognize that the man who built one of the greatest investment legacies in history is not selling because he is cautious. He is selling because he sees something coming that most of the market still refuses to acknowledge. Warren Buffett is preparing for the storm, and if history is any guide, when he finally starts deploying that cash, the opportunities and the potential returns will be historic.